Okay, so where we had left off yesterday was we modeled out straight line depreciation, and remember what we'd spoken about a couple things, but this is a tiered schedule because depreciation accumulates as more property is built. That's the idea, and that's the tricky part of that. So I think if there's anything that kind of confuses most people if you're not familiar with this, is how this works. So I would encourage you to practice this and make sure you know this, because this is a big thing that you would see in case studies. This is where a lot of people in the early exams kind of get thrown off, is having to build their own depreciation schedule. It's very easy to see this in a template and become familiar with copying this over again and then over again. But in a case study, you have to build it on your own from scratch. So start to become familiar with it. And you'll see in the latter tests, that's where a lot of guys kind of get thrown off, is the depreciation. So we'll definitely stress test it, but remember a couple things here is one, we built it off of the net PP&E. We combined, there was two categories of PP&E, the PP&E that was backed by a capital lease, and then just straight PP&E that was paid with cash, whether it was cash raised from debt or equity or cash on hand. We depreciate that as a whole. Remember, we used 20 years. That was a midpoint. That was a midpoint because they gave us a range of depreciation anywhere from 3 to 40 years. So the question is, what's the right rate? And I said, let's just throw in 20 for now to get the mechanics in there. This is something that a lot of analysts struggle with. If you remember, there was a depreciation table that was separated by asset class. And each asset class had a range of anywhere from 3 to 40 years. They had wide ranges. And so I see a lot of analysts trying to get into specific depreciation and thinking that they're going to get into a more accurate number by breaking up PP&E by asset class, and that doesn't necessarily help for two very strong reasons. What's flawed about that? What are those two reasons? You kind of following me? We'll get into that. Let's say they told us that this property had a useful life of 15. Forget the range. Useful life of 15. Even if you were able to get to that exact number, what's wrong with just taking this property and dividing it by 15? Even if you got an exact number, my point is, it still wouldn't be extremely accurate.
For a straight line depreciation?
Yeah.
In terms of a real world application?
Yeah.
Well, wear and tear is not going to be even over the years.
Oh yeah, no, you're absolutely right. But okay, so let's say in terms of just tying it to the accounting. So good point. Okay, good. Pressure. Let's put it. Let's illustrate this a little bit more. Okay, we used a midpoint here, right? So I'm going to pull in. You don't have to do this, but I just want to see, and I'll delete it quickly. I want to pull in how this compares. Yeah.
Can we have one more shot?
Give one more shot.
It's because the depreciation wouldn't come exactly at the end of the year. It'd be spread out throughout the year, and therefore, since we're assuming the cash flow is at the end, it's inaccurate from a sense of when it's actually going to take place.
That's part of it. Yep. Cash flow timing. Absolutely. Cash flow timing is part of it. So, whereas we in the model are depreciating this in all in one lump sum. Whereas probably the accountants had this rolled up in monthly or even daily inflows. So that's never going to tie. Something else that's going to have a bigger difference.
Isn't that like tax implication?
Yeah, but we try to work through that in the income statement. And we won't get that accurate as well. But Terry, you had something?
The asset mix and the depreciation rates will vary.
Yes. Why?
Because different assets will be depreciated at different rates.
So there's that, right? There's you can break this up by asset class and try to break up depreciation rates. But even so, there'll still be a bit of an inaccuracy. Why? It has something to do with the timing. I'm going to pull in the historical depreciation. Robert, were you going to say something?
No.
I was going to let me pull in, and you don't have to do this, but just to track, what was depreciation last year? It was 8130. So we have a drop. So I'm going to go into techniques for understanding where depreciation is supposed to be. And you can have a whole depreciation schedule with asset class and get specific, get into as much granular detail as possible. If I see a drop in depreciation like this, something's wrong, right? If I see a jump in depreciation from 8 to 12, something's wrong, right? What I want to see, no matter how you model it, I want to see growth in depreciation that's been consistent historically, unless there was some major asset divestiture or asset acquisition. A $200 billion company like Walmart would not have that happen unless you knew about it, unless it was some major announcement. Depreciation should always be steadily climbing. They have a core value of property that's depreciating at an equal rate, and it slowly climbs by what rate? In your prep question? The rate of Capex. Right? The more Capex you stack on, the more. This increase in depreciation is solely due to the depreciation on Capex stacking and stacking and stacking. You see it here. It's stacking by 750, 798, 840. This is what's making our depreciation grow. Why would it drop? Unless you have some major divestiture, some major issue. Why would it jump? We have some major acquisition. So you should never see any major shift unless it's known. And so if you see depreciation as growing at 6%, 7%, we don't have the year before, 7%, 6%, it should continue at that rate. So these are one of the things we'll learn over time. A 22% drop, something's wrong. Okay. Even if they told you that they depreciate their assets at a rate of 15 years, dividing this by 15 would not be accurate for two reasons. One, this is not the number they paid for the property. This is the number that it's currently at right now after depreciating for X number of years. So if I took this and divided it by 15, that would give me an inaccurate number. You have to take the actual purchase price and divide it by 15, which you might never get. So number one, with the straight line depreciation implies a depreciation at purchase. So you can't take, so it's basically like saying, remember the example we had yesterday? This is it right here. The example we had yesterday where we had 20 depreciation, property 20. This example was the property was $20,000. It's depreciated at 20 years, so it's $2,000 a year. Right? Now let's say we're modeling this and we say, all right, well, our net PP&E is 18. If we divided that by 20, we'd get a number, I don't know, we get a number much less than 2,000. That's not their depreciation. Their depreciation was 2,000 a year. So just by taking the net PP&E and dividing it by their stated straight line useful life is not going to give us an accurate answer. If we took the net PP&E and divided by 20, we're not going to get the 2,000 that they've actually been using as their depreciation rate. You need the actual purchase value. Eric?
So if you have the actual purchase value, depending on the purchase value or still.
So the other thing is you not only need the purchase value, but when they purchased it. So if you really want to get accurate depreciation, and you don't have to understand this completely now, but and we'll join this. If you want to get actual depreciation they type, you need to know every single asset they purchased, the value that they purchased it for, and the time that they purchased it for, which you'll never, ever, ever end up getting, no matter how much you have. There's no way. Don't disclose that information. So people say, well, if they gave me the actual number, useful life of 15, then I could just divide the PP&E by 15. No, that wouldn't even. You have to figure out an implied. To get this to 2,000, I need to divide this by, I don't know, what's the math? Of course. I knew that. So this 9 is a blended rate that takes into account the timing and net depreciation. We need a blended number to try to back into a number that represents what their depreciation should be. How do we do that? It's impossible. We'll never know.
So in that case, our best bet to be was let's use the depreciation schedule. And looking at depreciation, it wasn't as consistent. So that's the reason why I'm using the number that they have. It's based on the net, not.
Yep. So the best thing to do, unless you have the actual schedule of the properties that they purchased and when they purchased it, the best thing that they could do is you can do is tweak that number. I want a depreciation that reflects this trend. No matter how much you've analyzed this trend needs to be consistent. That's where depreciation should be. Otherwise, there's something wrong. So what do? My depreciation here is too low. Why is this too low?
It's with your PP&E.
The years. The year's PP&E is probably too high. If I divide my PP&E by a lower number of years, I should get a higher value. If I divide the PP&E by 10 years, I get 11. Now it's too high. If I divide it by, let's say, 15 years then, I get 8. It's all right. Maybe a little too low. So let me try 14 years. Let me drop it a little bit. If I do it by 14 years, that's pretty good. 7%. That's pretty much in line. No matter how much I've analyzed, breaking this up by asset class, things like that, for this reason, you're not depreciating by 20 years. This is a rate that represents how much life is left in the company, in the asset. Of all the assets blended, taking into account the core, the gross value of the assets and when they were purchased. So I know it's kind of tough to grasp at this point, but just more important, understand the mechanics that you just want to track growth historically, always, unless there is a major divestiture or major acquisition. Yeah.
Well, but also a way to do it is if the company were to break out gross PP, net PP, you can just subtract and figure out how many years have gone by, and then plug in. If it's not broken out, you can't.
If that's broken out by asset purchased.
Okay.
Asset purchase, not even asset class, because asset class is always going to give you a range because there's computers, machines, and all that stuff, which are all different. So you literally need like purchase orders.
Okay.
And if you get that information, you kind of want to hope that you can never get your hands on that information. Yeah. Yeah. It's impossible. Okay, but now we have a second problem. So yeah, fine, that's consistent. That's a nice 7% growth, but now it's a little bit too high here. What causes the what causes the growth after 2013? Capex. So Capex is what causes the growth beyond the PP&E year. Capex is what stacks, right? It's the Capex, it's the 700 that's causing the jump from 87 to 94 to 10. This is the addition of Capex year after year. So how do we make this growth more consistent with historical? We'll up the Capex life. So if I do this by, let's say, just 25 years, let's say, there we go, 6-7%. That's exactly what we want. That falls in line. I don't care how much you've engineered this. This is what I'd expect to see. Remember, depreciation, if you think about it, we'll talk about valuation soon. Depreciation is an expense that's after EBITDA. And even if you build it to net income, you're going to add it back to net income anyway. This is not something that really impacts your valuation. It impacts taxes, though. So we'll get into that.
So that's the whole point of it, right?
Yes, that's actually true. Okay. So short kind of the mechanical lesson, if the concepts are still tough to grasp, and you can read it in the book, and this is the one thing I would recommend you focus on. I mean, what we learned for the past week was just kind of projecting out cash flow statement is relatively linear, right? This is the one kind of concept that you should kind of study. And the core value of depreciation is impacted by the PP&E, right? So if your depreciation is way too low or way too high, adjust PP&E. This is the core of this adjusts the core value of the depreciation going forward because it's the majority of the depreciation, $8 billion. The future growth from year to year is impacted by Capex because it's the Capex depreciation that causes the growth that stacks year after year after year. So the first thing I do is tweak the PP&E to get as close as you can to the core value of depreciation, and then look forward. And if it's growing too fast, too slow going forward, then you tweak the PP&E years. And I usually keep the PP&E years consistent. Usually they're improving on the same property year after year as a whole. Not always the case, but. This throws a lot of analysts off all the time. People get into too much detail. This throws you off in case studies. The point is, what everybody looks for is a trend. So I see people saying, well, it said 20 in the case and this and that, and then this drops in half, and that's an issue. Again, quick way to get into this and get a good answer. Any questions on that? I'm going to delete this because we don't need this. Oops. Okay.
Paul, would there be
Yes.
a case in which PP&E is really going to be, or depreciation schedule is really going to be a material driver in a company's current situation, therefore you really need to get into the weeds when it comes to projecting? Or is this really, it's not going to impact valuation greatly, just hit it in and make sure it flows and you can back up your assumptions and move on to bigger drivers of value?
It's actually an advanced question. It does impact the taxes on valuation, which maybe arguably has a minimal effect compared to things like cash flow and EBITDA growth. But depreciation is something that's highly debated when buying a business, because the ongoing tax savings does hold value. So we'll talk about that in purchase accounting and in M&A. So in terms of core operating value, I don't think it weighs as much as in final stages of negotiating a transaction, the value of depreciation in the future, if that helps. We'll talk about what to analyze when buying a business, not for the sake of valuation, but for the sake of accretion dilution and all these other types of analyses that we'll look at in M&A. So it does, in short, it doesn't have as much of an impact to valuation as it does in M&A and acquisition analyses.
Thanks.
Yeah. And we will see why. In M&A, it makes a significant impact.
Just a quick question here, Paul.
Yes.
I guess the reason why we go up in years is because it's stacking each year.
Yeah.
Instead of going down.
Yeah. So that will reduce, that would soften the growth. It would reduce the impact. Yeah. Increase the years, it'll reduce. So now that we have straight line depreciation, we can link this into our model. Remember we drew out yesterday in terms of the steps. We have straight line depreciation. We can link straight line depreciation into our income statement and into our cash flow statement. So depreciation and amortization is straight line here. We're going to link this in from our depreciation schedule equals G23 equals G19 in the depreciation schedule. Copy that to the right. So your numbers are going to start to change. Your EBIT's going to drop. Your taxes will be impacted. Yeah. Okay? And this should also flow into the cash flow statement. In the cash flow statement, and we've already kind of linked it, it should no longer be zero. It should reflect the value of depreciation. Any questions on that? No? Yes? Okay. Now we have accelerated depreciation. Why accelerate? What is accelerated depreciation?
Just you're depreciating at a faster rate than the earlier, so let's say some equipment is maybe obsolete in a few years, so
Yeah.
you're gonna get more value out of it versus a few years out of it.
Right. So straight line depreciation gives us even depreciation over time, right? $20,000 truck has a value as a useful life of 10 years. Easy just to say it'll depreciate 2,000 a year, 2,000 a year, 2,000 a year, 2,000 a year. But in reality, trucks may not depreciate that way. Trucks may depreciate faster in the early years. There might be more wear and tear in the early years. And so for that reason, a lot of times companies prefer to go through a method of accelerated depreciation, where there's greater depreciation in the early years and less depreciation in the latter years. So in the end, you're depreciating, of course, the same value, but you're just depreciating more upfront. And there's a couple of reasons to do that. One, maybe you just generally believe that your assets depreciate faster earlier. And two, if you have higher depreciation in the early years, you can achieve more tax savings. Higher depreciation expense, lower EBIT, lower taxes. So this is one thing. Again, we talked about like things like revenue recognition in the beginning of the program. That there are things that you kind of have a choice as a company business owner in terms of how things should be accounted for. But in terms of staying within the boundaries of regulation, you need to come up with a view and stick with it. You can't just say, I want to do straight line depreciation this year and then accelerate next year, and then you can't flip-flop like that. You have to come up with a defensible reason for why you believe it is one way and stick with it. One thing I forgot to mention in straight line depreciation and any type of depreciation is there could be a residual value on a particular asset. So in this case, we took the value of the asset and divided it by its useful life. We generally do that in the modeling. But sometimes, which means that this has depreciated 2,000 a year, by year 20 it's worth zero. Some assets might have a value at year zero. It might not be worth zero, it might be worth some scrap value, just the value of its metal, maybe its parts. And if it does have a value of, let's say 5,000. So let's say by year 20, when it's fully depreciated, it won't have a value of zero, it would have a value of 5, let's say. So we want to calculate what the expected annual depreciation is on this asset, on this truck, but making sure that by year 0, it's not a value of 0, it's a value of 5. So you only want to depreciate the difference. You only want to depreciate the value that's allowable to be depreciated. So you only want to depreciate 15,000. Okay. So is that 750? You only depreciate so that by year 20 it's not worth 0, it's worth 5,000. So just the general rule for straight line depreciation is the asset value minus the residual value or scrap value over the useful life. And usually we just make the residual value 0. But just to note that some assets might have a value after it's fully depreciated. That's residual value. Yeah, that's all in the book. We really don't do that in modeling. Now so accelerated depreciation allows faster depreciation in the early years, and to compensate for that, less depreciation in the latter years. And there are several ways to do that. One method is called the declining balance method. So you'll never have to do this in the US. It's important to know. And there are several other methods mentioned in the book. It's good to know all the methods, or it's good to know several. Actually, knowing several will be a question on one of the exams. Which ones to know several? The declining balance method applies a percentage to the value of the assets. Let's say we have the value of the asset is 20,000. We multiply it by a percentage, and that gives us the depreciation. Well, what percentage do we use? We typically look at a multiple on the reciprocal of the useful life. In other words, if an asset has a useful life of 10 years, then we look at 1 over 10. And 1 over 10 is 10%. But you apply a multiple to that. 1.5, 2, 2.5, typically 2. And if you use 2, it's called double declining balance. Double declining balance is taking 1 divided by the useful life and multiplying it by 2, or 20%. So declining balance, or double declining balance, is 1 over useful life times 2. You can do 1 over useful life times 1.5. 1 over useful life times 2.5. Just got to ask what the assumption is. And so what you do is you'd apply 20% to the core value of the asset, and that's your depreciation. So your depreciation is 4,000. It's double what it would have been in straight line. Straight line was 2,000. It's double. And so next year, that's your one. So next year, you apply the same percentage, but to the net balance. So next year we have 16,000. You apply 20% to that. It's 3,200. And so on. Year 3, we have 12,800. Times 20%. And so on. So the balance is reducing, and then so you're multiplying by the same percentage, but so the value is reducing each year. That's the double declining balance method. Just know about that. My point is, you're depreciating the full asset. You're depreciating 20,000, but instead of evenly 2, 2, 2, 2, you're starting high and reducing lower, 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 lower. In the US, we use a different method. We use a method called MACRS. You should memorize it. This is the US tax method for depreciating, the modified, accelerated, you don't have to know this, maybe you do. Cost recovery something system. The system? What is it? System?
It's just called the
Schedule, maybe.
Yeah, system.
System? It sounds funny to me. When I'm looking at it on the board, it just looks funny. Modified accelerated cost recovery system. And basically, in this case, they give you percentages that start high and decline. They'll give you 25%, for example, 22%, 19%, 15%. And you apply just the gross value of the asset times those percentages. You're not doing the net value of the asset yourself. Basically, what they've done was they've calculated in what the implied reduction in percentage would be year after year after year. They've given you those percentages declining. So how do you get these percentages? You look them up in a table that they've calculated for, and you apply the gross value of the asset by those percentages. So instead of calculating your own percentage and multiplying it by the net, the balance here is declining each year. The balance here is staying constant. The percentage is declining. The percentage is something that you look up. They've baked in, they've calculated themselves what the implied reduction in percentage would be based on the declining balance method. I forgot what method was it, 1.5 or 1.25 or something. They've made a calculation for that. How do you know? How do you know? Oh, you got to look it up. So let me pull it up. And one way to get it, and I know they kind of changed it. I told you how to, I show you how to get it in the book, but I think unfortunately they changed the website link. But I just Googled Maker's depreciation table. Oh, here it is right here. Perfect. Maker's depreciation schedule. Here's the percentages. So if your property has a straight line depreciation of 10 years, these are the percentages you use. 10, 18, 14, 4, 11, 5, 9, 2. So we'll model this right now. If your property has a useful life of 15, you have to use these percentages. So if your useful life is in between these years, you kind of have to just pick one. We'll show you. Notice there are several different tables. There's 1, 2, 3, 4, 5, and something else. 6. There's a reason for that. Look at the 3-year. So 3-year straight line depreciation is effectively taking a property, $9,000, and dividing it in thirds, 3,000, 3,000, 3,000. 33% a year, right? So if you were to accelerate, you would hope that in year 1, it would be greater than 33%, right? 33.3333%. If you look at this table, 33.333%. This is not accelerating, is it? Should be, but it's not. Why not?
Paul, can you make it a little bit bigger, please?
Yeah.
Thanks.
Sorry. Let me just mention it to us in. We are not using the board. I will make it bigger. I gotta get this thing out of the way.
Is that only accounted for half a year?
Yes, exactly. Control-Shift Plus, does that do that? Zoom. There we go. Yeah. Yes, that is because, so the first year should have technically been 66.66%. But if you notice on top, it says half-year convention. What they're assuming in these tables is that the property isn't going to start depreciating until mid-year. So they cut what should have been 66.66 depreciation in half, assuming that the property isn't coming in line. So the difference between this table and the tables underneath are the conventions. This assumes the property isn't coming online until half the year. Underneath, notice the percentage went up to 58.33%. This is assuming it's not going to be placed in service until somewhere in the first quarter. So maybe a few months out. And then it declines from here because then they say, well, what if it comes online, placed in service in the second quarter? Or what if it comes online in the third quarter and the percentages reduce accordingly? Typically in modeling, and this is the fourth quarter, very low percentage. In modeling, we just take the largest percentage because in the straight line model, we don't account for Capex coming in line halfway into the year. What we do is, and of course, unless you get specific instructions, we typically keep a simpler route, and we assume, unless known, who knows when this Capex is going to come in, right? This Capex can come in, or this Capex can come in the beginning of the year, it can come in at the end of the year, we don't know. And actually, you can say that about any cash flow. Who knows when this cash is coming in? This cash could come in the beginning of the year. This dividend could be paid in the beginning of the year. It could be paid in the middle of the year. It could be paid at the end of the year. Who knows? But we're not going to go into every single cell and make adjustments based on the month. If you want to do that, go out and build the monthly model, right? So we're not going to tweak the Capex based on things like that. If you're going to get that granular, then just go out and build a model by month, not by year. You know what I'm saying? So typically for that reason in modeling, we're not going to go in and say, all right, well, this Capex is going to be half a year and this is that. So we'll just take the percentages that is as close to a full year's percentage of depreciation. And that's the one place in service in the first quarter. 58%, which is close enough. Any questions on that? So let's use this table to model out accelerated depreciation for Walmart. So if we go to the depreciation schedule, here we have the accelerated depreciation section. There are two areas here, one to lay out our percentages that we will apply, and one to actually calculate the depreciation. So for example, for existing PP&E, now we've estimated a 14-year useful life. So there is no table for 14 years, but close enough 15 years. So we're going to use the 15-year percentages. And so to use, for now, we will hard code in those 15-year percentages, 8.75%, 9.13%, 8.75, 9.13, 8.21, 7.39, 6.65. And we will apply those percentages to the value of the asset to create the implied depreciation. You guys got that? 875, 9.13, 8.21, 7.39, 6.65. Bless you. And so the way it works to get depreciation, we'll take the value of the PP&E times the percentage. So the 112 billion times 8.75 is our depreciation, accelerated depreciation 2013. So the 112,324 times 8.75 is 9828, right? A premium above the 8 billion that we've calculated before. It's accelerated. Next year, we multiply the net value, the 112, the same core value that we're using, times 9%. And so what you can do is, see if you copy to the right, you'll have a little bit of a problem. It's okay because you're multiplying by 9%, but the reference to the 112 has shifted. So we want to anchor just half the formula. We want to anchor only the reference to the 112. So if we go back to this existing PP&E formula that originally references F6, and if we anchor the reference to F6 by hitting F4 or putting a dollar sign in front of F, and if we copy this to the right, then it works because now we have the 9.13 times the 112. The year after, it's the 112 times 8%, 112 times 7%. Values declining as we go on. Oh, yep. Question on that? And we do the same for each Capex. So in 2013, we now need to look at what do we use? 25 years for Capex. Let's go to the table. There is no 20. It actually caps at 20 years. So let's use the 20-year percentages. 6563, 7, 6482, 5996, and 5546. So I'll just put this on the board so you can look at it. 6563, 7, 6482, 5996, 5546, and we multiply the net value of Capex by these percentages respectively. So in the first year, we're going to take the value of the PP&E in 2013. It's the 14 billion times the percentage 656. And what I've done was I've anchored the reference to the Capex so that when I copy to the right, the reference to the Capex does not move because you're multiplying each percentage as you go forward by the same core Capex, right? Times the percentages. Save the file. Got that? And you continue. Yeah? Next year, remember, it's Capex that hasn't come in until 2014. So we don't want to see any values here. We start in column H. We start the percentages in column H. We start the depreciation in column H. So it's the same percentages because it's total 25-year Capex, but we don't start depreciating at 6.56 until 2014. So I'm going to do 6.563 in 2014, 7 in 2015, 6.482 in 2016, and 5996 in 2017. Or you could have just copied the first 4 cells and pasted them over. Right? And so in 2014, it's the 2014 Capex that you can anchor times the 656. And you can copy that to the right. And so on. So see if you can try to get this all completed. Follow the pattern. This is what you should be, you got 3 days to practice this stuff. This is what you really should be focusing on. Okay. Next, do the same thing, but shift everything over 1 more year. We're starting in 2015. We're going to take the 2015 Capex, anchor that, times the 2015 percentage, copy to the right. And the same in 2016. We got 2 more years of depreciation. Multiply by the 16 billion, anchor that, times the 656, copy to the right. And finally in 2017, it's just the 17 billion times the 6%. And you can add everything up and you should have 12,559 in 2017. That's what you should get. Okay, so what do we do here? We accelerated our depreciation. Why? Why do we accelerate the depreciation? What's the purpose? We mentioned before, one purpose is some companies actually believe that companies depreciate faster in the early years. But we already have straight line depreciation for their income statement and cash flow statement. So this brings up the topic of deferred taxes. So let me enlarge this. Okay. So you are allowed to, under certain conditions, use 2 separate methods of depreciation for book versus tax purposes. You are allowed to depreciate your assets on, let's say, for example, a straight line basis for GAAP purposes, yet for tax purposes, accelerate the depreciation. Why would you want to do that? For tax purposes. So what do I mean? So if you have, it's easier that you can't, that's why I need the slides, right? That's why I gave you the handout. You can't really read this. There's no other way to do it. But so the point is, so this is 17 on the slide now. So the point is, you are allowed to change the method of depreciation for tax purposes, which could give you a benefit of saving taxes in the long run. So what do I mean? So for GAAP purposes, let's say you report straight line depreciation. Straight line depreciation is in the early years, a smaller depreciation than the accelerated depreciation. What's the benefit of a smaller depreciation? Less expenses, higher net income. So for GAAP purposes, you can report a higher net income, maybe favorable for public reporting, earnings per share, stock value, things like that. Yet for tax purposes, you can report an income statement with a different method of acceleration of depreciation, like accelerated depreciation, which gives you a higher depreciation, which means what? Pay less taxes. So instead of just reporting accelerated depreciation for GAAP, which might not be favorable because that might not show the best option for net income, you can do it 2 ways. You can get the kind of best of both worlds. For GAAP purposes, show a lower depreciation, higher net income, yet at the same time, for tax purposes, higher depreciation, lower net income. What benefit does that bring? So, in other words, in this example, we have two columns here, two different income statements. One on the left for GAAP, right? One on the right for tax purposes. Yep, page 17 if you want to see it better. So, the EBITDA, let's say here, is the same, 5,000. The depreciation for GAAP purposes is smaller. It's straight line. It's 1,500. For tax purposes, it's higher. We've accelerated the depreciation for tax purposes, 3,750. What difference does that make? That means for GAAP purposes, the lower depreciation gives us higher EBT or higher net income, 2,100. Yet for tax purposes, we have higher depreciation, lower net income, 750. So more favorable to report the higher net income for GAAP and more favorable to save taxes for tax purposes. However, we don't avoid paying taxes altogether. We're just deferring it in the short term. Later on, we're going to have to owe those taxes. So that difference, the difference between the taxes expensed, the 1,400 for GAAP purposes, and the actual taxes due, 500 for tax purposes, the difference becomes a deferred tax liability. Deferred tax liability. At 900. So in other words, we were able to defer our taxes, free up cash in the short term by accelerating depreciation. Deferred taxes are created by accounting differences between GAAP and tax, or between accounting for financial reporting and accounting for tax purposes.
So in our model then, we'll follow the
So that's why in modeling, and this is a good investment banking interview question, and a lot of analysts, this is a good example of how analysts, if you're using template after template after template, know how to do this but don't know why. In modeling, instead of modeling out two income statements, we calculate our straight line depreciation and we calculate our accelerated depreciation. And if you subtract the accelerated depreciation from the straight line, 3,750 minus 1,500 gives us 2,250. If you multiply that by the tax rate, you are getting the implied tax savings. That gives you the same number. So 3,750 minus 1,500 is 2,250. That times the number of the percentage of taxes, 40%, is 900. That's the exact number that matches the taxes saved, the 1,400 minus the 500. So in modeling, instead of modeling out two different income statements, we take the difference in depreciation times the tax rate. We model out the accelerated depreciation. We model out the straight line depreciation. We subtract the two, multiply by the tax rate. Because that is a way to get to the taxes saved by accelerating depreciation. Brian, you have a question?
No, so that's what, so when, the question I guess maybe let's say that when we're looking at the income statement, right?
Mm-hmm.
Would the depreciation and amortization are going to be linking the straight line or the accelerated?
We do accelerated.
So we do accelerated in the income statement, but then in our cash flow statement, we also use accelerated depreciation for the straight line.
So the cash flow statement, always straight line. Because you're undoing exactly what's reported on the income statement. Always. The only purpose for accelerating depreciation is to create this deferred tax liability. That's the only purpose it serves.
So we're modeling and we shouldn't worry about having that deferred tax liability.
Yeah, so that's the trick. So you could, I guess, try to model two income statements, but why do that? The only purpose that this serves in our modeling is to see what that deferred tax liability is.
So we just keep the straight line, but then we have that just to check our deferred tax.
Yep. So study this page. It tries to illustrate why we're doing what we're doing, and we will revisit it, but I think it's important to just do it. So we take the accelerated depreciation, we subtract it from the straight line, multiply by the tax rate, that gives us the deferred tax liability. There are other ways to create deferred tax liability. This is one example. Other ways are reporting COGS differently. Last in, first out versus first in. You guys know about FIFO, LIFO, things like that. We don't really do that in modeling. But there are other timing differences that could cause deferred tax liabilities. The biggest one is accelerated depreciation. And actually, in in Walmart, they don't really accelerate depreciation this way. But we're just modeling it out because a lot of times analysts do it this way, and I want to show you how it's done this way. But this doesn't make a material difference to the model. So just to know the process, you want to take the difference in depreciation, tax minus book. That's the difference in depreciation. The difference is what causes the tax savings, the adjustment. We multiply it by the tax rate. Tosin, I'm going to show you H30 now that you're back. Pull in the tax rate, the actual tax rate. Make sure you're pulling in the actual tax rate from the actual year. Don't put in 2012 tax rate into 2013. You won't get the right number. It's the 2013 tax rate, 2014 tax rate. Pull in the right tax rate. Multiply the difference in depreciation by the tax rate. You sure? Okay. We can go back to it after class. Pull in the tax rate in from the income statement. And you multiply.
Would we be able to turn it off this factor?
I can call them up, but by the time they come up here, we'll be 10 minutes left. Is it called back down? No, it's in here. Yeah, no, that doesn't work. It's in there. Sorry, if you had mentioned at the break. You can, open the windows. You can feel free to open the windows. That'll bring some heat in real quick. Yeah, thanks, Alistair.
It's like a liar's poker comment. We don't share out the window together.
Oh, yeah.
It's like what?
We were talking about liar's poker. Michael was talking about the analyst or aspiring analyst who was told to open up the window on a skyscraper, and of course you can't, so he took a chair and threw it out the window.
Oh, really? I never heard that. Okay, this is what you guys should be getting. Tosin, you sure you're all right? We'll give it a couple minutes to make sure you guys can tie numbers. Yeah?
Okay, please, I just want to see the formula for Paul.
It even, I remember as an analyst, it took me quite a while to really fully understand, to get this. Just, I tried to lay it out nicely in the slide. It's also in the book. This is something that you want to maybe revisit when we do the second model and the third model. And as you dig deeper, you'll slowly gain a better understanding of it. So don't worry about it too much. Scratch the surface, get the mechanics down. As we look at this in different ways, as we do paper examples, we'll do a lot of different examples. We'll slowly start to get it, if you don't get it already. Yeah, Jack.
Oh, so the benefit of using this decreased, accelerated depreciation is to pay less tax in the short run.
Yes. Yeah, only in the short term. You ultimately have to pay them back. It's a liability. It gets booked as a liability. You're required to obviously pay them back. You're just deferring in the short term. Mm-hmm. Any other questions on that? Pulled it in directly from the income statement. And on the income statement, we kind of rounded because we found a note. Yeah, we found a note on the income statement where we got the tax rate from. We found an income statement that said the tax rate should be 33 to 35%. So we just hit the midpoint.
So what would be like the thought process behind like using accelerated versus straight line if it's all in the long run would be the same? Are they just trying to make the income statement or look a little better for that?
They want the cash.
They just want the cash.
Yeah. Yeah, I don't know if it illustrates it better, but if you remember from yesterday's example where we left off that in this example, you might want to flip through these on your own or just kind of read it in the book. We had 2,100 in net income, right? That was, I guess, last week, 2,100 net income. So in this example, he had repairs to make on his truck of 1,000. Thought, all right, I made 2,100 net income. I can make these repairs to my truck. So you go to the cash flow and he realizes he doesn't have 2,100 in his bank account. He has only 100. Why does he have 100 in his bank account? Because of the 10,000 in cash, a portion of that did not actually come in cash. A portion of that was on credit. Depreciation, 1,500, he did not actually pay. So if you take the net income and build a mini cash flow statement, adjusting from net income to cash, you subtract out the 3,500, the revenue and credit, you add back the 1,500, we get to 100, which represents the actual number that's in his cash account, 100. So if you remember, we did that yesterday. So what does he do? So this is one way to free up cash in the short term. He could say, all right, well, I could save taxes by accelerating depreciation. And that's what I'm trying to do here. So in this case, so here the cash flow statement was 2,100 minus the 3,500, the revenue on credit, plus the 1,500, the expense they didn't pay. That's 100. Now, let's say we decide to accelerate depreciation for tax purposes. So he decides to accelerate depreciation for tax purposes. Here we are now. This is the same income statement that we've just seen a couple slides back. On the right, I'm just illustrating what the tax income statement would look like. Same up to EBITDA, higher depreciation, less taxes, 500. So what does he have now? He's expensed 1,400 in taxes, but 900 of those taxes he didn't pay. So he gets now a second add back to his cash flow statement, deferred taxes. Now he's got his $1,000 and he can make the repairs on his truck. So that's the thought process. Freeing up cash in the short term. Definitely sit with that. This deferred tax number, we now, just as we showed you in the example, gets added back into the cash flow statement. So in the cash flow statement, we can now link in deferred taxes in from the cash flow statement. So slowly getting that together. Yes?
Well, if you have short-term and long-term deferred tax liabilities on your balance sheet, where do you want to feed this? It seems like it would be long-term, but does it really not matter as long as it's house?
It doesn't matter really so much as long as it adds up to total assets, but this would probably be long-term. Short-term, actually, this would definitely be long-term. Short-term is a little different. Short-term deferred taxes is literally taxes incurred in a particular year that you need to pay by December. And we'll talk about this. We'll see this in the Heinz case. So this is definitely long-term. Taxes are due what? March 15th, right? Yeah, March 15th. For corporates.
Oh, really?
Yeah, March 15th. So taxes are due March 15th. And so let's say you owe $1 million in taxes to the company. And usually you pay it right away. But sometimes you say, I don't want to pay it right now. Can I pay it in monthly installments? So you book a short-term deferred tax payable that you need to pay by the end of the year. Totally different thing. It's literally like an accrued expense. That's a short-term deferred tax. That's not based on timing differences between tax and accounting and all this property asset stuff. That's just literally you owe the government a certain amount of money, and you're going to pay it a few months later. That's a short-term. We'll see that in that's a deferred tax liability. Now, how does this differ from a deferred tax asset? That's it for depreciation. So So study it. We will practice it, of course. Now let's talk about working capital. So we'll talk about as much as we can. Working capital is, by definition, a measure of a company's current assets less its current liabilities. So we didn't really talk about balance sheet, assets, liabilities. We'll talk about that next week. But an asset is something that is owned by the business that's expected to have some sort of economic benefit in the future. Examples of assets are cash, property, right? We talked about that. Accounts receivables. A liability is a debt or obligation, right? A current asset is a resource who is expected to have economic benefit, but the expected benefit is expected to come in within the year. Current asset, current, expected to come in the year. An example of a current asset is accounts receivable. You record a sale on credit, the customer should pay you within the year. Otherwise, you might have a collections problem. A current liability is a debt or obligation whose obligation is to come due within 1 year. So, examples of current assets or current assets, current liabilities are what we've been talking about throughout. Cash is a current asset. Accounts receivable is a current asset. Accrued expenses is a current asset. These are all items that you'd expect to be converted into cash within the year. Sorry, prepaid expenses. Right. Current assets. Current liabilities examples are accounts payable, accrued expenses, short-term debt. Current liabilities. That's working capital. Working capital is the current assets less the current liabilities. Helps us determine how much cash will be coming in this year and what our obligations are this year versus anything that might be long-term. Good measure of cash flow to come. Yes, sir.
The purpose of the bonding on short-term debt was like a treasure.
Yeah. So, good. I was just going to explain. In modeling, though, we use a narrower definition of working capital, which is called operating working capital. Operating working capital is current assets, not including cash, less current liabilities, not including debts. You have to memorize that. It's a question on the test. What is the difference between working capital and non-working capital? Everyone gets it wrong. Why is this important? Because when you wipe out cash and debt from your operating working capital, your working capital analysis, you are left with all the line items that are dependent on your operations. Accounts receivable is dependent on your revenue. I forgot about inventory, right? Inventory is going. Inventory is based on your COGS. Accrued prepaid expenses is based on your expenses. Accounts payable is based on your COGS. Accrued expenses is based on your operating expenses. These are the line items that represent cash that's going to come in and cash that's due directly from the operations, the sales and operations of your business. That's important. You don't want an infusion of cash or a debt raise to mask what might be a true operating working capital shortfall. So in modeling and working capital, we look at these items to determine how well is our cash being managed from our current everyday operations. And that's an important thing to analyze. There are managers hired to just manage your operating working capital on a day-to-day basis. Right? Yes.
Is there like a reference that we can look up where it has like the operating accounts versus non-operating accounts somewhere?
I don't think so. You mean it's just everything except cash, and then everything except debt.
Because I thought like they had like those funky like contra revenues and all that stuff.
You do, but if it's not cash related, the contra revenue would still be in there. I don't think it's more complicated than that. And if there, I don't know of a reference that would lay that out specifically. But working capital has significant and important uses. And one is to really kind of track how well you're managing your day-to-day operations. And you have to think about it in relation to the operations. A good example is if we had accounts receivable of 25 in 1 year, so we have accounts receivable of 25,000 in 1 year. And next year we had accounts receivable of 50,000. This is increasing. Is that good or bad?
That
Why?
we're getting cash on the income statement.
You're not collecting any cash. But what if your revenue is growing?
Correct. This could be that maybe you're doing a lot of sale or credit.
Maybe you're selling more.
Or you're changing terms a little bit to boost sales.
Maybe you're changing terms to boost sales. But my point is, if this is 25,000 on 100,000 in sales, and this is 50,000 on 200,000 in sales, maybe this isn't so bad. Maybe this means that your business is growing. How do you know? Well, for this reason, we don't look at just the absolute number. We need to look at these working capital line items in proportion to some sort of operating measure. And we use the example of days. So for example, if your accounts receivable was 25,000, but your revenue was 100,000, that means of your 100,000 in sales, basically 25% was on credit. Right? And so we use this measure called days to extrapolate in a year. What does this mean with days of receivables or collections outstanding? So if you take 25% and you multiply it by 360 days, that's 90. We use 360, you can use 360 or 365. It's up to you. A lot of people sometimes use 360 because it's divisible by 12. So if your model turned into a monthly model, you don't have to adjust for February 28 days and all that stuff. It's just 30, 30, 30 all across the board. And so if you look at the $200,000 AR divided by 50, that's also 25%. And also 90 days. So in other words, the days can help us track if an increase or a decrease in a working capital balance is healthy or not. If your AR is increasing in direct proportion with revenue, then that could be a good sign. That means your business is growing. If AR is decreasing, but your revenue is not, that could be a bad sign. If your revenue is not increasing, then 50 divided by 100 is 50%, and that means this is 180 days. A rise in days means we might have a collection issue, or our AR is increasing and our revenue is not. So days helps us manage the adjustment of a working capital item in proportion to some sort of operating item for that reason. And it's important to think about this days formula. A lot of people just memorize the formula, but it's the percentage of the working capital balance divided by some operating assumption times the number of days. That's how it works. And so the first thing you do when building a model, well, that's the general idea for working capital. We'll revisit that. We will revisit that on Monday. But if you look at the model, like depreciation, we have to create our own working capital schedule. This is not something that's projected or created by, in the financial reports. And we have to, when creating our own working capital schedule, we need to look to the balance sheet to determine what are the appropriate working capital line items. We look to the balance sheet. We look at the assets, we look at the liabilities, we look for the current assets that doesn't include cash, we look at the current liabilities that don't include cash. So if we go to Walmart's annual report, And if we look at the balance sheet, so we'll spend next week hard coding the balance sheet completely, but you'll see that we have in the asset section current assets, total current assets, and then non-current assets. Right? The non-current assets are basically property. This is all property we added together. Goodwill and other. Pretty simple. Current assets are cash, which for working capital we will not include. We have receivables, AR, inventory, and prepaid expenses, just like the examples I gave you, the major line items. They have this discontinued operations. This is one time. Anything one time extraordinary we will not include. We'll just project it at 0. But we have 3 key working capital line items. Bless you. Bless you. Working cap receivables are always related to revenue. Inventory is always related to what income statement line item? COGS. Prepaid expenses is up in the air. It could be some sort of operating expense. Luckily for us, Walmart has just one operating expense line item, so we don't have to really think about that too much. But if your company has several operating expense line items, then you got to think about what's the expense they're prepaying. Prepaid expense is an expense where it's like the opposite of getting billed. You're paying before you get billed, like rent sometimes. Maybe paying the first of the month instead of the end of the month. Looking at the liabilities. Here are our short-term liabilities, total current liabilities. Our long-term is basically long-term debts, capital leases, deferred taxes, and this non-controlling interest. This is the non-controlling interest holder. We'll talk about that guy. So for current liabilities, short-term debt, don't include. You exclude debts. We have accounts payable. We have accrued liabilities. Accounts payable is related to what? COGS. Accrued liabilities is like accrued expenses, OPEX. We have accrued income taxes. This is just, Daniel, what you spoke about. This is the short term. This is not the deferred taxes based on deferring the depreciation on stuff. This is just your billed taxes in March and you have to pay by the end of the year. So this will be in relation to the taxes due. Long-term debt, these are debts. We don't include that. Capital leases, debts, you don't include that. Again, discontinued operation, this is one-time non-recurring, we don't include that. So we have 3 current assets and 3 current liabilities. So we want to lay out our own working capital that has 1, 2, 3 current assets and 1, 2, 3 current liabilities. We will lay them out historically and back calculate into what the implied days metric is based on the relative operations. That's what you do. We'll use those days to make our projections, just like we use the percentage of revenue in the income statement to make our projections. That's how we project working capital. Not that complicated. But these working capital lines are going to be helpful and useful in bridging the gap between the balance sheet and the cash flow statement. More specifically, in linking into the cash flow statement here. So on Monday, we will link those line items into this cash flow statement. And when we do that, we'll have pretty much everything together for cash flow. We will then finalize hard coding the balance sheet. We will use the cash flow to build the balance sheet, probably get through that by Tuesday, Wednesday morning. By Wednesday, we'll have the debt schedule done. And we'll be finalizing the model, and we'll start talking about valuation next Thursday. So I think this is a good stopping point. Any questions?